Okay. How is Whoa, that was very loud, sorry. How is everybody doing? Are we all still awake? Johan's table. Are you guys still awake? You're having fun. That's good and bad. It's good and bad. I'm more happy than not. So we're gonna start back now. I would like to introduce another sovereign debt expert who has worked extensively with the ALSF and on various debt matters on the continent and throughout the world. He is an excellent expert, and you can ask him any question. Any question that you have. Yanis Manuelidis was a partner at Allen & Overy and is now consulting for his own organization called Elmar Advisors. So he's going to talk to us about key considerations for incurring non-traditional debt. For this presentation, the questions will come at the end, but you can still use Slido to type in any questions if they pop into your head as he goes along, and then we'll pause at the end for a break so that you can either do the old school way or the new school way for your questions. So welcome Yanis to the stage, please.
Well, thank you, Nicole. Thank you all for being here. I hope the previous panel warned you at the as they were leaving to have a double dose of coffee or strong tea so that you could keep awake. I must congratulate those who had the perspicacity to leave early and go to their beds before waiting for what might be a soporific topic. I hope not. So thank you all for being here. Thank you all for the ALSF for asking me. And I have to say I was very impressed hearing everybody standing up and saying what they've done and what they do for their organizations. I have to tell you that I'm a great believer in what Africa can do. It's a big challenge for all of you, but also for the world. I don't want to put it in anything but really the extreme terms that it deserves, that Africa can be a brilliant success for the world, but also can be a big failure for itself and for the world. And it's really up to all of us. And I hope more to you. And I certainly, as somebody who's, well, I'll tell you more about me, but I just want to help you. And I think you have, by all means, the capacity and the human capital in almost every country that I've come across in this continent to do it and succeed. So I really mean that from the bottom of my heart. So thank you for listening. I'm very happy to take questions at the end. And I've already promised Nicole that I will do a follow-up Zoom session, maybe with Rodrigo, to take up any further questions that we haven't asked, because the guide certainly that I have covers a lot of topics, in principle, and some specific topics afterwards. So I'll tell you just a bit about who I am. There's a biography and all that, but I just want to tell you I'm a Greek national. I studied philosophy in the States and then law in England. I qualified as a lawyer in England, and then also went to Paris for initially a year and then stayed there for 6. So vous pouvez me poser des questions en français si vous voulez, mais
you can ask me questions in French if you wish, because I also lived in Paris. But do not hesitate to ask me questions in French as well.
Years I qualified as a French lawyer, and I first did then my first sovereign deals, which are several billion ECUs, equivalent of euros at the time, to countries of the ex-Soviet Union, all linked with trade finance deals with the European community. And then when I returned to London, I did a lot of project financing, which ultimately is underpinned by the sovereign. I did a lot of sovereign securitizations, which were trendy at the time. I think they're now less fashionable. And I did a few other sort of structured financing before getting involved in the Greek debt crisis. but in all sorts of ways in the Greek debt crisis. But one of the interesting things at the end of the crisis was not just the usual things that one associates with a crisis, but how could Greece use its assets to grow again? How could it use them in other than just a simple privatization, sell them for cheap? And so I worked back then on a platform of an independent institution that could do that. And I've sort of been following issues of sovereign accounting at the time since then, and I've co-authored small pieces on this. And I continued sort of working on sovereign debt, and I headed the Alan Overy sovereign debt practice for many years, and then we have a compulsory retirement, and I have sort of retired and work still with A&O. As part of this presentation is the work with A&O, and also my own. I just want to tell you that because I have a slight, quite varied background on finance, and I've worked on a number of different issues over the years. So don't feel, if my approach tends to be kind of initially very generic and broad, it's partly because I think that that's the only way to understand some of these issues. So here you see what it is that this presentation covers. The guide covers all that and more. The idea is that there is a first section which approaches the issue of what is traditional debt and what are the key considerations, how should you be approaching it. And it's almost, it's if you want, theoretical first principles based. We'll go through these during the presentation. The second part of the guide focuses on particular topics, secured lending broadly, but then also commodity-backed financing. I have a little bit on that in the presentation. Project financing and negative pledge, how you deal with it. And then it has sort of new instruments. I talk about Islamic finance, again, at some length. And I cover also loans, just generally, not and what are the considerations you have for them. And finally, I have something on plurilaterals. That's all in the guide. Here, it will be an overview of the principles, because I think the principles are what are important for you to be able to assess any new financial instrument that comes around. But also, it will help you understand better the existing ones you have. And we'll probably put some of these in perspective. So with all of this, I'll go to the slides. So the audience is basically you. I mean, I've assumed that you would be who you stated you were in the morning. And I assume, again, that most of you are economists or finance experts. And again, that when you deal with debt instruments, you focus on just the cash flow provisions, so principally in the cash flow provisions. And often simply what is kind of the cheapest at the moment. Why? Because it's always very difficult to go into your finance minister and say, well, here's this other product, but it costs a little bit more, but we should do it. It just doesn't sound good, and it may lead you in trouble. So this is I assume is always it's not just a problem or a feature of you. It's a feature of any debt management agency and any Minister of Finance in the world. And the question is, should this always be your approach, and how should you approach debt instruments when you are offered? So you focus on what's called traditional debt, on the cash flows. I don't know how much you focus on non-cash flow provisions in these instruments. And also, I don't know how much you focus on how traditional instruments between themselves, when put together, actually result in something kind of novel, if you want, non-traditional. So the question of what is traditional and non-traditional is obviously the first key question of this presentation. It was a question I had when I was given the topic. And most of you probably think that non-traditional debt is something like that. It's a structure that looks as complicated as that, and that you just cannot make sort of heads or tails of how the thing works. Well, I hope that by doing, first of all, a little bit of a historical sort of just go back history and doing a bit of genealogy, and also then focus on key features, you'll be able to start taking all these things apart and figure how this thing we just saw works. So I want to say that until the end of the 1980s, syndicated loans were the traditional thing. People raised money, countries raised money with syndicated loans. They use a little bit of bonds, but not really. Most of it was loans. And the assumption was that the floating rate loans would sort of stay more or less at the level they were because everything was underpinned by the Bretton Woods Agreement. But of course, that came apart in 1971. Slowly, the interest rates started going up. These rates were pushed on to the poorer countries. There was a debtor assumption that the lenders are both willing and able to restructure, which were the banks. And the creditor assumption was, in the words of the then head of Citigroup, or Citibank, whatever it's called, sovereigns don't go bust. And so they were not having any reserves. So they were unable to do anything. They stood there for like 10 years until they built enough reserves and the US Treasury came up with a Brady bond solution. So that was, and then we shifted into bonds, and that became the traditional. And again, people thought, the creditors thought, well, in the last decade, lost decade, Mexico and the others had bonds, they never restructured them, so bonds surely are much safer, so we'll go into bonds. And the debtors thought, well, these guys who buy bonds are, have deep pockets, so they can afford losses. So let's all pile into that. And then, of course, them wrong, and we needed to have a whole sort of years and years of discussion of how we solve the collective action problem in bonds with first, series by series CACs, and then the aggregated CACs, and that you all know the story. If you don't know the story, have enough references in the footnotes and the annex of my guide, where you can read the story. But again, that was an assumption because, unfortunately, contracts are always incomplete. And so Argentina in 2020 showed us that the assumption that somehow even aggregated CACs would solve everything was wrong. It threatened to do certain things. It retreated, but still that was, we were faced again with the fact that something which we thought was traditional and well-known and could function well actually malfunctioned when needed or threatened to malfunction. Ian has written a paper on that, which I commend. So you've seen this before. I've put it now in a schematic sort of, again, I like the historical approach. So immediately after the World War II, you have these people, these people who are the key creditors. And then as you go around clockwise, I've highlighted in red the new creditors who come in. And as you see, more and more come in. And there's no reason to expect that this will stop here. Basically, anybody who has surpluses, anybody who's a major trader, anybody who can think of something new and fancy and can mobilize finance will come and join if it makes commercial sense to them. And so that's another feature of what I call non-traditional. So you have these new entities coming in. And again, you can see how this changes over time. And again, you've seen, and Rodrigo mentioned in the morning, the instruments. And so you have, again, instruments that can vary, quite a lot. You have, financing which is given for projects, specific projects, and can be given direct to sovereigns or to SOEs. But it can also be very focused and be done on a standalone basis, making sure the project basically can pay for itself. And these are all each one of them is very, very different type of finance, and it requires different considerations. You've had commodity-backed finance. We'll talk a bit about it a bit later. It used to be very fashionable in the early 2000s to have securitization, sovereign securitization. There's a paper by the IMF saying how great it is. I'm pretty sure they will disown it now. But it was very big, I can tell you, because I did a lot of those back in the early 2000s. And you can have, of course, other secured finance. We all know about sort of the oil deals, the debt service reserve accounts, export receipts accounts, etc. And you have also the new instruments. You have, of course, the Islamic lenders coming in who have major surpluses from the Gulf countries And they come with their own instruments. And these have to sit along whatever other instruments you have. And also you have the new lenders, which include, of course, the Chinese lenders, the regional lenders and non-bank lenders. And there will be more of those non-bank lenders for a number of reasons. And you have the plurilaterals. And then you have this odd thing that has emerged, like entities doing budget support loans or central bank swaps. And at a time of crisis, they come and say, well, hang on, that was not meant to be really a loan. It was meant to just give you some liquidity. Please pay me in full. And how you deal with that when it's either you or your central bank who has taken it is still a major, I think, unresolved issue. Unless, again, Ian has resolved it in the meantime. I'm sure he's trying very hard. And then you have all the multicolor sort of bonds, the green, blue, et cetera, and sustainability bank. And there will be others talking about these. So, in all this thing, in all this sort of universe of changes, how do you make sense of all of this? And my approach is go back to the fundamentals. So what are the two important features of sovereign debt? And the first is that sovereign debt is a public good. We all fret about debt. This is a conference so dealing how you deal with too much debt, etc. But at its essence, sovereign debt is a public good. And again, it was mentioned this morning by Rodrigo, and I want to repeat it. There's some references in the full guide. But for those who've been reading the Financial Times, there's a great article today by Martin Wolf who makes the same point. And I'll come back to some of the points mentioned in that article, which is completely coincidental. I didn't ask him to write the article. So anyhow, so for the sovereigns, it's a public good. For private equities, it's just a means basically to maximize return on equity. And that defines the purposes of the debt, its contribution to public welfare, economic growth, and its public nature. And the second point is the feature is that a sovereign is a special type of debtor. Insolvency for sovereigns means something completely different from private entities. And that, again, sets the perimeters within which public debt can be reset and restructured. And, even in good times, reset. That you don't need to wait for, everything to go belly up to reset your debt. So let's look at the first principle very quickly. So the corporate debts has a very narrow goal, to increase the corporate profits, maximize returns for the equity holders in the capital structure. But the sovereigns do not have an equity structure, a separate equity tier in the capital structure. So the equity holders really are the sovereign itself, the citizens, the enterprises, the common welfare. So if you want to look at it by reference to DSAs, when a creditor does your DSA, a DSA for your country, it will basically look to see whether it can be repaid. When you look to your DSA, you need to make sure that the creditor can be repaid, but below there is enough money to do all this, for all the social and development goals and welfare goals that you need for your country. So how you do your DSA and how you incorporate debt instruments into your DSA from the very beginning is, I think, very, very important. So, because exactly the ability of the sovereign to raise debt is any credibility to sustain it. It's both the two things, to raise it and to sustain it is essential for everybody. It's for its own domestic economic growth and overall for even just any enterprise domestically. So the sovereign debt has to be managed for the benefit of the public as part of overall good governance. And what is the public benefit, of course, is always a big question, and it's always a part of domestic political economy. And this will evolve, and this will be a matter of debate within each one of your countries. But that's where it rests. It rests with the sovereign itself. So what I want to take out of this is that the cost of capital, accounting for sovereign assets, determining sovereign debt sustainability is a far more complex than for any corporates. And in fact, it's far more complex than when you do it than any creditor does it, including the IMF. So the first principle that I would take out of this when analyzing any debt instrument is how do you account for it and how do you incorporate it in the cash flow and your debt sustainability models and how you approach its non-financial provisions. And that basically means, coming to the point I made earlier, that it may be that the debt instrument is actually not the cheapest, but it actually contributes to the overall greater growth and welfare and sustainability. So that's one thing to keep in mind. Oops, where is it? Previous one. No. Yeah, okay. So sovereigns are special debtors. So, again, that's a point that you probably have heard many times, and I'm sure Rodrigo, it came up in Rodrigo's presentation. They're not like corporates. At most, what creditors can do is have an insulating law that will allow them to say to the debtor, you owe me this money. But if they get a judgment, they cannot really enforce it anywhere. And the debt can be rewritten or written down just by consent. There's no insolvency law for sovereigns. And here, you can see the contrast between the corporates and the law. And basically, it's because sovereigns are the creators of the law. They're not subject to any law. So they operate in a slightly different sphere. It doesn't mean that they don't have, they're not under pressure, they're not under compulsion, but the compulsion is never legal. There are no hard legal constraints on a sovereign. And what happened in Argentina litigation is a big discussion, but in my view, it was completely an exception and probably unrepeatable in all sorts of ways. So again, very important, sovereigns are special debtors. So there are no hard legal constraints except what the sovereign expressly accepts. Decisions on what to do, they will be based on overall cost-benefit analysis of the sovereign's interests and constraints. And if you think that that's extreme, I can tell you in my own country in 2015, the then Minister of Finance decided to default on the European Central Bank and the IMF and not to default on the holdouts of the English law bonds of 2012. He chose to do it. He could do it. Nobody could tell him you can't do it. Now, the consequences were terrible for the country. So the cost-benefit analysis was he completely got it wrong, but he could do it. That's the important thing. He could do it. So you have the situation where this face-off, debtors cannot write down the debt, creditors cannot enforce. So absence of legal compulsion, too many creditors, a huge collective action problem. There's no finality in this process, as there is with corporate insolvencies, where there's always finality. So unless there is sovereign and its creditors agree on a solution, and the solution is possible if that both believe in two assumptions, that you following the restructuring, the sovereign will be able to return to prosperity. If that's not something both believe, there won't be a solution. And that the relationship is long-term and symbiotic, and that actually is very important for you to remember, because when choosing even creditors in the beginning, it's a topic I'll come back to. So because the sooner your economy returns to growth, creditors will be able to be paid back and may recover even some of what they lost. So that leads to the second principles for you to consider, is how you ensure that any future resolution of the collective action problem is resolved and resolved in an optimal way. So these are these are the two features and two principles. I've just put them again. I'm not going to go again the slide, but just to remind you, sovereign debt is a public good. Sovereigns are special types of debtors. So therefore, when you deal with your public debt and any new instrument, you have to think, how do I account for it? How do I incorporate it in not just my cash flows, but also in my overall asset and liability management and my overall debt sustainability and my growth? And how do I ensure that if I ever have to restructure my debt, even absent, a deep sort of bankruptcy and a crisis, how do I do it and do it effectively? So here I just put something which most of you will know, but nonetheless I wanted to put it out there, because what I do in the guide is I set these principles, not those principles, the categories, the types of provisions that you will find in any debt instrument. And I have lots of colleagues who will correct me if they think that I've missed a category, but basically any debt instrument you have, however disguised it is, or whatever it says, if it's really a debt instrument, it will cover these points. And I have a discussion in the guide about each one of them, and I revisit these provisions when in my annex on the loans. But what then I do is I have in the remaining chapters discussion of, as I told you, secured debt, project finance, commodity-backed finance, a discussion of negative pledge, and then new forms of debt like Islamic finance, and loans that can take sort of new forms, and plurilaterals. And I could add several annexes to this guide, and maybe there'll be a sort of second phase, and we'll add more of that and give more specific examples. So that gives you the overall outline of the guide. So what do you do? And what does the first part of the guide do? It sort of helps you ask the appropriate questions by reference to these two principles. So you have to account and incorporate the instrument in your debt flow, cash flow, and your debt sustainability for reporting, accountability, and day-to-day cash management. You have to allow for contingencies to ensure their sustainability. You don't want surprises. You want to be clear about what purpose you're using, and does it contribute to growth, and what assets does it help develop. And you need to think, obviously, of whatever are your specific management challenges. And evaluate what's advantageous and onerous. Okay, that's sort of obvious. You strive for uniformity of terms, because you need to have a back office to monitor everything. You don't want to have, drown in a sea of different instruments where provisions of business days are different in each instrument, and notices provisions are different, and this, that, and the other. You want simplicity in that so as to avoid mistakes. You need to account always for what is the legitimate interest of your creditors. I mean, some of my colleagues will occasionally take the view that you can squeeze a creditor by putting this provision in, and you try to show how clever you are on some things. And in some cases this is appropriate, in some cases it's not appropriate. You've got to acknowledge they're giving you the money because they want to be repaid and pay the interest. And so if you think it's, you don't like it, or you don't like some provisions, you can discuss. But if you don't like it, trying to kind of, do funky deals or put funky provisions in won't really help you, because you want to have a relationship of continuous trust with them. Because something goes wrong, you want them to basically be with you as continuing and returning players. And a point that you need to have advisors, and I cannot overstress the point. Things change all the time. There's new things coming up. There's some things that experience can dictate, but also some things that kind of the most recent transaction can dictate. So it's extremely important to get advice. So the second principle means that each debt instrument for each debt instrument, you must consider your contribution to the GDP growth and what is the interest of the creditors in it. So if a creditor comes and says, I want to do this commodity deal with you, I mean, what is it? It's interesting. How does it contribute to your GDP growth? Does the creditor actually have a stake in how you develop in the next 20 years, 30 years? Or is it they're just out to get the commodity and then say goodbye, and you won't have another creditor around? That's very important. You need to understand the structure, the novelty, the complexity, the scalability, and ease of managing of each of these instruments. So is it a one-off? Am I going to be filled in with just one-offs, non-traditional stuff, and then just, as I said, drown in a sea of complexity? Can I scale up and bring in the type of investors I want? And this is actually very important. Identify the investors. Who are they? Are they going to be cooperative? Are they your long-term partners? What are their funding and capital costs? If something goes wrong, do they have the elbow room to move and do what's required? Can they absorb losses? How large are they? You may find some niche investor who's willing to give you a fantastic rate, but you may be committing something to them that prevents you from doing something else more broadly. So you need to think of that. And is there a process for binding minorities? Because that's ultimately the big point in any collective action problem. So, and if you undertake the obligation as a guarantor, you have to evaluate the risks, oversee the terms of the performance of the guaranteed entity. Just don't just sign the guarantee. Don't just say, well, in any event, I will have to bail them out. Just go and check what it is that they are agreeing to, because ultimately it's on your head. And it's going to come at the worst possible moment if you don't monitor it. So secured finance, as you will see when we go over it, I'm not totally against secured finance, but it is a very dangerous area to be at. Almost everything with secured finance is non-traditional, I would say, because it brings up novel questions. So you have to evaluate carefully whatever proposals you have. And then you have to understand the fragility of the arrangements. So how easily can they be terminated by the creditor? The default provisions, the undertakings assumed, are you going to be on the back foot from day one? That's a part of what is, I believe now in the Ukraine litigation, have they been put on the back foot from day one? And so that's a very important point. Where do you stand? And then you need to think of your creditors as a whole. Intercreditor equity is a point that you need to consider from the outset when you enter new agreements, because you will appeal to them if you want to change things. And the more they feel that you treat them all fairly, the more when they all get together, they will not gang together against you or in groups against you, but they will get together to do what I said earlier, to help you, regain your future. So this is another thing that you need to do. So I'll now just turn to the secured finance considerations. And what I've done here is, I've put the pros and cons. And I'll just go through them with some extra comments. So it's always tempting, especially if you are less developed, commodity-rich countries. And we all know a country in Africa that was so tempted and got itself into trouble. And maybe the example I'll use may be referring to them. But it's always tempting because it's much more, if you're a less developed country and you have a good commodity that's very easily marketable, what's the easiest thing to do? It's just go and sell it and get cash. You wouldn't, at prices that you wouldn't dream of if you try to borrow otherwise. But if you don't do it right, it will impede economic development. It could create an uneven playing field amongst your creditors. It will obscure the state of public finances and the state assets. It will disguise the true economic health of the sovereign until it's too late. So so you need to ask, is this the only way for accessing markets? Am I committed to a narrower investor base? Is it does it fit with a long-term strategy for economic growth? Diversification of my economy out of just this single commodity, and ultimately access to a broader investor audience on an unsecured basis. Unsecured financing should be your goal, even if you start with secured financing. It's my own advice. And so will the proposed security interest will be public and publicly registered? And I have in the guide a discussion about registration of securities and quasi-securities that are not registered. And what's important about that is that if they're not registered, if they're, they cannot be seen, it basically creates a problem of so-called false wealth. People think that you have more assets than you really have. And what it does to your other creditors when they discover it is actually not something you want to be confronted with because they will feel cheated. So is it public? And the accounting treatment, will it show assets and liabilities? Again, does it create false wealth? Will it not unduly inflate your assets and leave future liabilities uncovered? And again, if you think of what happened to this particular African country, you know that that's part of the problem. Exactly all these things happened. And so, again, we go to the issue of how all these things reported and accounted and to various audiences. So then the next thing is you need to think, because I said sometimes secured transactions are not bad, but you need to think, what does it do? Is it just there to give the creditor a super priority in times of debt distress and provide an advantage to them over the other creditors? Is it, however, as in a project finance, which is well designed, just there to protect the particular project and the investment from outside creditors? Is it just defensive to allow basically the cash flows that everybody planned at the outset to basically unfold as planned? Is there an incentive that you offer to creditors to basically give you some finance to help you out of an impasse at a collective restructuring? And debtors, countries who find themselves in difficulties, even before they officially call the IMF, etc., will have lots of proposals of this type. I worked with Greece for 6 months before they finally went to the IMF. And you cannot believe the amounts of proposals I got, the craziest possible proposals. And they were all on the basis of security. And none of them would have done anything to Greece, but each one of them was tempting for the minister because it meant they delayed the day of reckoning. And it is your duty, and it's hard duty to discharge, to point this out, that the day of reckoning coming will not save you, in fact, will make it worse if you do a deal which is unwise. And you have to also consider what other debt instruments you have and what restrictions you have, negative pledge arrangements, and so when you do a security. And you need to think of how the other creditors will react. As I said, you need to view your creditors in a holistic way, as an overall group, people that you deal with in the long term. What will they think? Will it cause a rift? Will there be a fight? So here it is, commodity-backed funding. LDCR is the less developed commodity-rich country. And I'm talking about a structure which is more developed in the guide. It's a prepayment structure for future deliveries of the commodity. Let's say it's oil. So it's an arrangement where you go and the trader says, I will buy from you for several years, so much percentage of your output. Not, on the basis. And here is a payment up front. It's a big, massive payment. It's very, very tempting. And what the country commits to do is to give them back oil at market prices, prevailing at the time when they do the deal, which will generate, according to this initial model, enough proceeds to satisfy the pre-agreed repayment schedule. So trader comes and gives an upfront money for many years of buying commodity, and the country basically says, well, I'm looked at the price, and that basically means I commit, 60% of my output for the next 10 years. But and that, by the way, that's good, because it means that 40% of the commodity can still be sold. It's not committed to repay this prepayment, and the sovereign can use it for other purposes. But if the prices rise, it's even a greater bonanza, because they don't have to commit 60% of the output, they can commit 30%, depending on what the price is. 40%, less. They have even more available cash. But if the opposite happens and the market prices fall, then the percentage available for falls, and you may end up as a country having to give all your output to the trader just to satisfy, and even that may not be enough. And that basically means two things, which are catastrophic. Basically, you have no money for anything else in the country. And second, if you go to the IMF and you say, please help me, the IMF says, okay, mate, we'll help you. How are you going to pay us back? Because the IMF always wants to be paid back. And you won't have any money because we'll have been committed for 10 years to the trader. And you'll have to wait in misery until prices recover. And that is, I'm afraid, the sad truth that's happened in this continent. Now, people have criticized deals of this sort because they say they're not transparent. Again, in the guide, I've given you enough information about a similar deal that's happened in northern Kurdistan, which was actually fully transparent, because at the time the trader financed the prepayment not with a loan, syndicated loan banks, but in the bond markets. And the offering document is out, and I've put all the references, you can get it. And so it was all fully transparent. It failed for all sorts of other reasons. So it's not just transparency, it's the structure that's fundamentally wrong. So there is, I have views about what an alternative could be for a commodity-rich country that needs to raise cheap financing through a contingent instrument. I won't present it now, but if you want to discuss it with me, I'll be very happy to. But I think there are other ways, and you need to be innovative on how you do that. So let's see what this commodity-backed finance structure looks like. And it all may look a bit like that, but I hope with what I've told you, you'll be able to understand a little bit better. So this is a standard example prepayment structure with a little bit more complex than I presented it, but it's all in the slide, so you'll be able to see it. And the only difference in the northern Kurdistan is that where it says lenders, it was actually a public bond. So the next point is, and it's a very important point, how broad is or should my investor universe be if you're an official? And the pro is obviously as broad a range, the more the merrier. Bring them in, give us money. It gives us options. It lowers the cost of debt. And that's actually correct, I think, provided that the outreach is broad, it's inclusive, and investors have to be, however, return players. I mean, there have to be people who are prepared to come and invest in your country again, and possibly in other things. They are tied to your prosperity, not necessarily through the terms of the debt instrument, but through their commitment overall. And they are there for the long term. Now, the con is, you have too many creditors, it becomes too difficult to manage everything. And also, the collective action problem becomes just unmanageable in times of distress. So you need to think of each creditor type separately. You need to think the needs of your country for the particular financing, and you need to determine who are the most suitable creditors for this financing. And in addition, you need to think, are they new investors I'm approaching or existing? And if there are new investors, is it worth the effort? So, you may be issuing euro bonds, but somebody comes and says, you can go and do a registered deal and so directly to the US investors, deepest markets in the world. And that's a very valid point. Maybe there are investors in the US who don't deal with Eurobonds, but the regulatory compliance for a registered issue, as my friend Ian will tell you, is much higher than for Eurobonds. So you take on an additional responsibility that you may not be able to manage or will put strains on your resources. So it may be a good idea, but can you do it? So if there are existing creditors, are you just fragmenting your pool, or you are enhancing an existing group? Are you just taking from one pocket and putting in the other. So that's important. And does fragmentation increase or decrease the collective action problem? So are they more likely to be cooperative than existing investors, disruptive, et cetera? You need to think of all of that. So, and you also need to think for each creditor type and for almost for its creditors in a debt instrument, how easy it is for them to absorb losses in cases of debt distress. I mean, remember, in the Latin American crisis, the banks, American banks, could not absorb losses. They just did not have the reserves. And so when the problem came, nothing could happen until they built the reserves, and the U.S. was willing to put some of its own treasuries at risk. What's the funding cost they will have if you cannot repay? Will it be excessive? How may it vary during the funding costs also during the life of that instrument, and if it needs to be rescheduled. So these are just not, these are things that you need to consider for every instrument, but particularly if it's new, if you haven't seen it before, don't have the collective experience of, we've seen how it behaves. And you need to think at any time, how large is your any specific creditor is by type, amount of exposure, special gravity. Special gravity, investors are, Chinese, policy banks are special gravity investors. I mean, just give an example. And how does each creditor's percentage participation in the overall creditor composition assist or impede a major reset? So these are all, I think, very important and valid questions. So I want to turn to, I discussed this again at great length in the guide, and you can just go and see some of the examples, but I want to turn briefly to sukuks and conventional bonds. And so I don't know how many of you know anything about sukuks and Islamic financing. I started doing Islamic financing when it was kind of all starting, and actually I did kind of an Islamic type financing before it became a thing. And then people discovered me and they said, we have some deals like that in the Gulf, can you help us? And I started doing them. I remember asking a colleague, I said, this Islamic financing, is it going to be big? Should I be focusing on it? And he said, no, it's a passing fad. So that was a missed career. But Islamic financing is big, and it's very simple for that. There are huge surpluses coming mostly from the Gulf, but not just. There are some wealthy countries and wealthy investors in Islamic countries who want, for their own reasons, to invest in instruments that are consistent with their key tenets of their belief. And you've got to take this very seriously. If you're going to do Islamic finance, you don't have to be a Muslim to think that the approach is serious. I tried in the guide to explain that it has all a very legitimate basis and it deserves to be taken seriously. And I give some examples of how practically to deal with it. But it is a very important source of financing for, I think, African countries. And the big question, how exactly they work, I have an example in the next slide, doesn't really matter. A sukuk is basically has to be able to generate cash flows that presuppose an underlying commercial transaction. It cannot be debt. It has to be a cash flow that, even though it imitates the debt cash flows, it actually derives from a bona fide commercial transaction. Now, we won't go in discussion about how Islamic scholars approach this, etc. All I want to say is that, unlike the early days when I first did this, and I remember for each country we had to go and ask for a different kind of Islamic scholar to say how you do this, and we did tweaking, etc. The banks who do this business have all now almost in-house scholars, and they have kind of standardized the approach. So it's kind of easy, but again, you've got to be respectful of the principles. Very important. So the big question is, okay, you bring this in, but you also have conventional bonds out. So what happens if you need a restructuring and you want to bring them all in a single vote? So for conventional bonds, we know that we have aggregated collective action clauses. We can put all the series of bonds into one voting group if we want. If you want, it's up to you. Or split them up. But can you bring in the sukuks, the sukuk holders in. So the answer is yes, you can, if you write it correctly. And I won't say more, but there's at least one country out there who has done it correctly. It's never been tested, but it has done it correctly. And if it ever has to do that, I think it can aggregate successfully. That, I think, for the country, by the way, I think is going to be a big plus, because sukuk holders will be more inclined to accept the restructuring, because it's more consistent with the fundamentals of Islamic principles. It is absolutely there, in the book. It says, that you've got to help. And so being able to aggregate a group of holders who is prepared to help you at the time of need with others who are maybe prepared or not is actually important. You have already a group of yeses in your group. So how you do it is important. Now, technically, it's still difficult. You need to get good advice. You need to get the drafting absolutely to the T. I've got some drafting in the guide to show you how it can be done. And you've got to make sure you don't mix governing laws. So one of the mysteries, and maybe, again, Ian, sorry for picking you up on this, like what Rodrigo did to me earlier, but maybe you'll be able to answer. But, sukuks tend to be governed almost exclusively by English law. I mean, I've not come across any New York law governed sukuk. And so how you might aggregate New York law bonds with English law governed sukuks, I do not know. Maybe you still can. But again, it's something you need to discover. And by the way, this has not been stress tested. This aggregation has not been stress tested, but it just shows you, and the drafting shows you how, for a non-conventional instrument, what it is that you need to think so that you can anticipate difficulty at the same time as you enhance your audience, your investor audience. So here, it's all in the guide. This is basically how a sukuk sort of works. Again, it looks like the Rube Goldberg thing that I showed you at the outset. It's very complicated, but I won't go into the details, but basically you see, again, it's an underlying commercial transaction that generates cash flows. Now, before I finish, I promised to say something about plurilaterals. I don't have a slide on this. But basically, plurilaterals, why are they important for you? Well, they're important because, it's basically extra money. And for a lot of plurilaterals fund development finance. And again, that's very important for you. However, the difficulty with plurilaterals is that they all think that they're multilaterals. But when it comes to the stress, the IMF thinks, well, not all of them are. So there is this discussion that Rodrigo mentioned in this book, and again, all the references are there in the guide. But there's also the specific discussion about how plurilaterals were treated in the Zambia restructuring. So the IMF, the most recent, I think, report on Zambia, the IMF has a discussion of how it decided that the particular plurilateral would count as a multilateral for the purpose of the restructuring. Why is this important for you? Because genuine multilaterals are subject to the IMF's no arrears toleration policy, if I forget example. Basically, it means they are out of the debt restructuring perimeter. It means it's debt that won't be subject to any renegotiation. It won't change unless the lenders want to change it. So it means more pain for everybody else. It means more pain for you, because for every creditor that does not participate, it's not just more pain for the other creditors, it's more pain for you, because you are also sharing into this pain. So plurilaterals are very, very important. They provide this finance, but when it comes to the crunch, will they be in or will they be out? Now, you will want them in. They will want out. You need to be aware of that. You need to think of how it will play, but you need to put this in your calculus of possibilities. The other thing about plurilaterals is you need to see what terms they lend. So there's one plurilateral, I can name it because no secret. So the New Development Bank, I don't know how many of you have loans with the New Development Bank, but it lends, the terms of its loans, it says this loan is governed by public international law. Now, I was asked to give an opinion, a legal opinion on a loan of this sort. I think it's a very interesting legal treatise that I wrote. But when it comes to the crunch, I can tell you, public international law, will not help you solve detailed questions that you may have. And you as a debtor, you may have a legitimate interest to go to the court yourself, not wait to be sued, to clarify some points in your debt instrument. It won't be so easy. I mean, you'll have arbitration, a new development bank, and of course, this will be solved politically. But all I'm saying is that this is an unusual clause. You won't be able to negotiate it because it's not up to the lawyers. It's drafted in the statutes of the new development bank. So you need to think of these details. Money is money. Money is good for development. Money is, if it's cheap, it's good. But again, just you think of, what the downside would be when you have to restructure. So on this note, I hope that those of you who are still awake, and I haven't put you to sleep, will be interested in seeing more of what the guide has. And thank you very much. And I'll happy to stay here to answer as many questions as you want. And happy also to have a follow-up organized by the ALSF on more specific points. And I can bring more specific points. If you ask me, I'm happy to kind of prepare, even if they're not in the guide. So thank you very much, and thank you again, ALSF, and thank you all for all, and good luck. You have a great and important responsibility. And I'm sure you'll do very well. Thank you. Could I ever ask the question to please bear with me, because you may not be, it's obvious, it won't obvious to you, but I'm sometimes hard of hearing, and I suffer a little bit from tinnitus, which is this buzzing noise, so just voice out and be slow, and I'll try to answer as best I can. Thank you.
Shall I go first? Thank you, and I congratulate you on this, even though it's technical, but it's my own area. I major in finance. And I remember when I was doing my PhD, I wrote a little proposal to my supervisor. All the question he asked me, Professor Glenn, maybe you have come over his work, Glenn Arnold. He said, you mean this one, no interest? I said, yes. And then this one, conventional, you pay interest? That is very interesting. So having said that, what I just want to ask is, do the non-conventional finance, that is the non-traditional, is there a specific market now that has been expanded, or it's a developing market?
Yeah.
And are you treating it in isolation, or you are subsuming it into the conventional financing window?
Yeah.
Thank you.
Thank you. So it's a very good question. It goes actually to the heart of the problem I had to struggle with. So when they say, write this thing on non-traditional, I said, well, heck, it's non-traditional. As I said, loans used to be traditional, bonds not traditional. So nowadays, I think what I classified as non-traditional and what I developed is almost all secured finance for me is non-traditional in the sense that it always changes. And in a way, loan finance is also non-traditional. It's, of course, traditional in the sense we used it, but the terms keep on changing, and the uses of loans change. And so that is also kind of non-traditional. As banks change, new entrants come in. And then you have, as I said, new instruments, like the Islamic instruments that come in. You have new types. I mean, a lot of debate has been done about Chinese lenders and the terms that they lend in. I think that my personal view is that Chinese lending after Zambia and Sri Lanka will change, because I think their attitude has somehow changed. I may be proved wrong, but so we will wait to see what they will do. you will have, I think, new kinds of financing proposals for commodities. Why? Because there are a lot of commodities in Africa. As I said, it's a very tempting, very easy. And these commodity-backed financings, there are many types. Again, in the guide, I go over some other types. With time, everything becomes conventional. You use it, there's some missteps, hidden costs revealed, difficulties. People figure out how to do it. They standardize some of the more difficult clauses and they move on. And that's good, but you will always have innovation. Financial innovation is going to be here. And quite frankly, for Africa, who needs huge amounts of money for energy and infrastructure, and needs to do it in a sustainable way, the financial engineering and innovation we'll need is huge if we're going to succeed. And the reason I approached it the way I approached it is because I want to have youth asking the generic questions. Because in my view, they always come up, these questions. And you need to be clear whether you are an economist or a lawyer. And all you can get from the most recent examples of non-traditional debt is just see what issues they bring up and what difficulties there are. But we will have lots. We will have an expanding, more and more and more instruments. Some of them will be discussed in the next few days. I didn't cover them on sustainable financing, et cetera. But we will, and as I said, we have to. But you have to approach them with the two principles in mind. How does it contribute to your growth and sustainable long-term growth? And if it goes wrong, how do you deal with it?
Lastly, closely following these questions, and as a build following my last question, I've seen where this sukuk was issued, and people subscribed, and some sovereign government use it, especially in my country. I saw the situation where this sukuk debt was issued, and it was used in infrastructure development, especially road. So do you share my opinion in terms of looking at it from the perspective that in the future, it can be used to transform the infrastructural deficiency, particularly in energy, power, and roads?
Yeah.
Thank you.
Yes. So it's a bit of a nuanced answer, but the key answer is yes, but it depends. It depends on not the investors, because sukuk certificate holders, like bond holders, cannot police the purpose of the money they've given. They can't. That's not, no term in the sukuk or the bond instrument can do that. Some terms actually, that purport to do that make the loan, make the debt more expensive. So you don't want, they cannot do it. So the only person, if you're using anything which is a capital market instrument, whether it's sukuk or conventional bond, the policing will have to be done by you. I mean, you will have to select the projects, and you will have to apply them, so that they actually promote the growth of the country. And that's why I said it's so important to have a debt sustainability analysis for you, which doesn't look just at the repayment of the debt, but looks at what is, if you want, the return on equity for the country, which is the growth of the country, the prosperity, the social development, and all that. So, capital market instruments, I think, have this inherent defect. Now, there's ideas about how you can couple capital market instruments like sukuk certificates or bonds with other schemes, other arrangements to allow for external guidance in case the country decides not to do quite what it ought to do. But I think some of this will be discussed. It's like the philosopher's stone, try to do that. If we can find a way to do that, we will have solved Africa's development problem and the world's problem. But more important is you need to do it. You are the custodians of this money. You need to put it to long-term growth.
Thank you very much. I think there's some question coming there, so I stop there.
So, I don't know. Let me put my question first before you read through that. My question is on the community-backed financing. So, It's here.
Sorry. Sorry, I'm just...
Yeah, that's okay.
Can you start again? Because I thought somebody was reading from the question. Sorry,
That's
apologies.
okay. That's fine. No. I want to ask a question on the what I classify as the resource-backed financing instruments, and your presentation has rightly, talked about the pros and cons of the finance-backed instruments, whereby you're paying back by some of the country resources. But we have also seen, some innovative financing instruments where instead of getting the cash, for your loan, you're actually getting the commodity or the resources, and you pay back in cash. So I'm not sure how the guide has looked at it in terms of what are the pros and cons, and how do you, evaluate and assess those kind of instruments. Do we put them in the same category as the commodity-backed financing instruments, or we treat them different in terms of the analysis?
Yeah. Okay, so that's a very good question. I mean, without knowing more, I cannot really say, except go back to first principles. But I can tell you, sort of an idea I had, which may be crazy, and I'm sure it will be shot down by a number of my colleagues. So what I didn't tell you, one of the things I worked on is a GDP-linked bond. And I think one of the presentations will actually cover it, the London term sheet for GDP-linked bonds. So these are bonds that fluctuate both in principal and interest on the basis of GDP. So your GDP goes up, you pay a little bit more. GDP goes down, you pay a little bit less. So good times, it's almost like an equity for instrument for sovereigns. Now you could do something like that based on oil receipts or oil output, and allow basically for, tell your counterparty to take a risk if the price goes down, and also take an upside that will compensate them for, when the price goes down, when it goes up. And that will always allow you to have an extra element that will remain available for your remaining needs in the country. Now, as to the particular thing that you've asked me, if it is, I mean, for me, countries that have commodities, of course they have to use them. I'd be mad not to use them. But, the questions I would ask is, okay, I get the money out of this. How much of it stays in the country to promote other growth or to invest somewhere else? So take Saudi Arabia, for example. Saudi Arabia is using its surpluses to basically build developments in the country, water, sort of new cities, etc., universities, because it knows at some point they're going to run out of oil. And it uses the surpluses, I think, in a wise way. And it has also used some of them to keep on investing in other things so as to be able to continue to have an income when they run out of oil or when oil will not be used. Because they also have a population explosion problem, like most African countries. So, so if you want to think of how do you deal with commodities, here is, look at basically Saudi Arabia or UAE. I mean, it's the same thing. So, is there a surplus? Is it invested, for long-term growth? Does it promote social development? Again, you'd be surprised. Saudi Arabia, has made huge progress in, women's education, women's financial inclusion, training. Again, most people, there's prejudice about this, but they wouldn't expect it. But they've invested in this thing. So the question is, are some of your surpluses stay to invest for what is your equity in your country? And if they do, then go ahead with it, because that's a useful asset to have. Oh, sorry. Okay, so why are they considered large? Well, I don't think they are considered risk-free unless you are the United States or Germany, maybe. If you borrow in your own currency, you're considered risk-free, and the assets have zero risk weighting. But that's basically convention that the Basel, people tell us. Risk-free assets are very important for the function of an economy, And a country needs to have its own domestic debt, and it needs to be the anchor risk-free asset for the functioning of the domestic economy. But developing countries won't have that before some time. So I don't think that's, they can create their own law, they can print their own currency, but as I said, unless you're the United States, that is the largest debtor in the world, but still everybody trusts its currency. It's just, I cannot see how it can work. So what's the biggest challenge with sukuks? So yes, so the question is, what is the biggest challenge with sukuks in the restructuring context in terms of how they're structured? So I think the biggest challenge is, the biggest challenge is how do you get the same clauses that you have in the bonds, the collective action clauses, to work? How do you get your investors all together in a group to ask them the question that you want about the resetting of your economic terms of the instrument, and how is it that they decide? And pretty much the terms in a well-drafted sukuk instrument mirror the terms of the bondholder of the bonds. Now, what's crucial is that they are drafted in a particular way. I have the drafting in the guide, so you can see it from. It actually comes from the Pakistan programs, bond program and sukuk program, but Pakistan has both. And you can see from the drafting, the way they're drafted, they link together. So it is possible, if Pakistan, for instance, decides to do a resetting of its debt, to aggregate all of this together and to go to all its investors and say, guys, gals, here is basically two instruments, a new sukuk, a new bond. And they have these features, and please, vote for it and select which one of the two you want. You don't have to, So, if you've drafted it correctly, you can have all of them voting together. And that's very persuasive, because then nobody feels left out. Nobody feels they've gotten a worse deal than the others. So it's just a question ultimately of drafting, and it can be done. Just look at Pakistan. Pakistan has done a good job on this. So next is, what are the most likely lenders of commodity-backed financing? Are they banks, fund managers? Well, I don't know that I'm sufficiently qualified to answer this question. Certainly, bilateral lenders who are interested in importing commodities will be. I mean, I think the Chinese banks have been doing this for a long time, probably continue to do that. Again, I think you will probably see a change in what they need, because I don't know whether you've been following the news, but China's carbon emissions will start dropping from next year, and there will be in a dropping sort of sense. So the kind of hydrocarbons they will need will drop. So it's something to consider. So bilateral lenders, I think, will definitely be there. Fund managers, I don't think the fund managers have currently the wherewithal to do that. Not that they're stupid, but it's not part of what they currently do. Banks, again, I think they will be driven by commercial considerations. You're more likely to find this in private credit. Private credit is an ascending force in the world of debt. That's basically the private equity houses, which now not just invest in equity, but lend money, and they lend in enormous amounts. They have not yet entered this market, but I think if they see an opportunity, they will come, and you can bet anything that their loans will be highly structured and non-traditional. So they're likely to see it from private credit. So are resource-backed loans the same as commodity-backed loans? Yes, the answer is yes, they are. I mean, is it not true that sukuk must have underlying assets from which it derives its returns? If so, how could the proceeds be used for something different? So yes, that's exactly correct. There is an underlying commercial transaction. In this, I think, example that I gave you, it's the lease of land. And it generates commercial revenue. And that commercial revenue basically then generates the floats that pay the sukuk certificate holders. How could the proceeds be used for something different? Well, I think the proceeds of the commercial transaction cannot be used for something different. They have to be used for the sukuk. But when it's all set up, the Islamic scholars view what the purpose of the debt advance to the country is, and they kind of sign off on this. So they will not, if the country says, I'm taking an extreme example, if the country says, oh, I want this sukuk financing to kind of build up my gambling industry, it will be no, it won't not be allowed. But if it is to build infrastructure, energy plant, it will be fine, I think. I'm not an Islamic scholar, but I mean, I'll just give you an extreme example. And equally in a restructuring, I mean, no one will go and do a restructuring with, a purpose that's, fundamental contradiction with Islamic finance. So which one do I see? The last one. Are plurilaterals considered commercial creditors? Well, that's the question. That's as we said, the important question. It's like, now you see it, now you don't. Sometimes they are, sometimes they're not. So the paper that is mentioned in the guide and was referred to several times by Rodrigo of the IMF sets out the principles on which the IMF will consider whether it's a commercial creditor, and hence within the perimeter of debt to be restructured, or outside and will count as a multilateral, and therefore the no toleration of arrears policy will apply to it, and it will be basically super senior. Now, the plurilateral will want the latter. You may not say it aloud, but you'll want the former, because more debt participates in the restructuring, the better for you. So, is the commercial creditor. That ultimately will depend on how what the IMF decides at the time. And the principles are in that paper. And if you want to see a specific application in respect of the Nordic Development Bank, I think, you will see the rationale of the IMF set in the Zambia, I think that's most recent assessment of Zambia. And it's there. And again, in my guide, I've given you the reference to that, so you don't need to look for it now. It's there. So it's not up to you, it's up to the IMF. What is the next? Oh, was that the last question? Gosh. Well, thank you.